Hey everyone. So, if your portfolio has been looking like a sea of red lately, well, you are definitely not alone. It feels like everything from the hottest AI stocks to crypto is taking a nosedive. We're going to spend the next few minutes unpacking exactly what's going on.
So, what is the deal? Why is it that all these assets that were on fire just a little while ago are suddenly dropping? Now, while the pain is pretty widespread, a lot of folks are pointing to one asset in particular as a kind of early warning system for the rest of the market. And that asset is Bitcoin. You see, because it really started its slide before most other things, we can kind of use it to decode what's happening everywhere else. It really is the classic canary in the coal mine. If Bitcoin is struggling, it signals that there might be danger ahead for, well, everyone. Okay, so to solve this whole mystery, we kind of have to look at two main suspects. On one side, you've got the technicians. These are the folks who live and die by the charts, believing that history always repeats itself. On the other side, the economists. They think all of this is being driven by huge, global, big picture forces. So, who's right? Let's kick things off with the technician.
All right, force number one, the charts. The core idea here is pretty simple. Markets are really just driven by human psychology, fear and greed. And humans, well, we tend to repeat ourselves. Technicians believe that by studying all those past wiggles and lines on a chart, we can actually predict what's coming next. Let's look at one of the most compelling patterns in Bitcoin's history. An analyst named Benjamin Cowan pointed out this pattern in Bitcoin's history that is so regular it's almost like clockwork. Check this out. From a market bottom to a market top, it has consistently taken about 1,050 days. And then from that high point all the way back down to the next low, almost exactly 1 year, 364 days. I mean, it's kind of spooky. If that historical rhythm holds, the charts are suggesting the next big bottom could be sometime around October 2026. Now, beyond those huge long-term cycles, traders are watching for signals that are a lot more immediate. And one of the most important ones is called the 50-week moving average. It sounds fancy, but all it is the average closing price over the last 50 weeks. And for traders, it acts like a critical line in the sand. The rule for a ton of traders is actually incredibly simple. If the price is trading above that line, hey, it's a bull market. We're in the good times. But the second the price breaks below that line, that's a major red flag. It often signals that a bear market, the bad times, is kicking off. And this is exactly what just happened. Not too long ago, Bitcoin's price dropped right below its 50-week moving average, which at the time was sitting around $13,000. For all those technical traders, this was the sell signal they were programmed to look for. It triggered a cascade of automated selling that just didn't care about any of the good news you might have been hearing in the headlines. But what if the charts aren't really the story? What if they're just the symptoms of something much, much bigger? Well, that brings us to our second force, the global economy. From this point of view, all those chart patterns are just ripples on the surface, being caused by these massive, invisible currents moving money around the world. One of these huge global forces that's now going in reverse is something called the carry trade. For years, it was like the ultimate financial hack. You borrow Japanese yen for almost nothing, thanks to their zero interest rates, and you plow that money into US assets that pay way more. But now, Japan is finally raising its rates. That free money machine is shutting down, forcing investors to sell their US holdings to pay back those loans. And at the very same time, the U.S. Federal Reserve is signaling its own big change. They're stopping a program that was designed to cool down the economy. Now, on the surface, that sounds like great news, right? But seasoned investors, they get nervous. They know the Fed usually only makes a move like this when they see some cracks forming under the surface of the financial system. So while the Fed is saying, hey, we're just being proactive, investors are hearing, uh-oh, something is about to break, and they start selling. So we've got the charts and we've got the global economy, but what if the biggest threat isn't external at all? Our third theory suggests the pressure is actually coming from inside the house, a kind of civil war, a fundamental identity crisis brewing right inside the world of Bitcoin itself. And this whole conflict really boils down to one massive question. What is Bitcoin? The original OG vision was for it to be one thing and one thing only: pure, simple, secure digital money. That's it. But some recent updates have introduced this totally new vision: Bitcoin as a permanent, decentralized hard drive for, well, anything. Pictures, text, you name it. And this new vision has a lot of the early adopters really, really worried. They're afraid it's going to clog up the network with junk, open up new ways to attack Bitcoin, and, could even lead to illegal stuff being permanently saved on the blockchain. For these purists, this whole identity crisis is a betrayal of the original mission, and it's a big enough reason for them to just sell and walk away.
All right, our fourth and final theory, and this one comes from a strategist named Jordi Visser, offers a totally different take. It suggests this sell-off isn't a sign of a crisis at all. Nope. Instead, it's a natural, maybe even necessary, part of Bitcoin's evolution into a mature global asset. Visser calls this Bitcoin's IPO moment, and it's a brilliant way to think about it. Imagine when a tech startup goes public. It's the first real chance for the founders and early employees to finally cash out their stock. He argues the exact same thing is happening right now with Bitcoin. For the first time ever, there's finally enough money flowing into the market for the earliest of adopters, many of whom are literal billionaires on paper, to finally sell their huge holdings without totally crashing the price. And the scale of this cash out is just mind-blowing. The firm Galaxy Digital recently handled a single sale for one person worth $9 billion. Can you imagine? Just a few years ago, trying to sell that much at once would have vaporized the entire market instantly.
So what changed? Why is this possible now? Well, it's the arrival of all this new money from things like Bitcoin ETFs and big institutions. It's created this deep pool of liquidity that acts as a cushion. This finally allows the OGs to get their payday. So what we're really seeing, according to this theory, is a slow-motion, historic transfer of wealth from a tiny group of early believers to the masses.
So there you have it, 4 really different, but honestly, all pretty compelling reasons for why everything is selling off. We've got predictive charts, massive global economic shifts, an internal identity crisis, and this giant cashing out moment. The big question is, which one is the right one? Well, the most likely answer is that it's not just one of them, it's probably all of them, all happening at once. You can think of it like a weighted index of truths. Each of these forces is pushing the market down, but some are probably pushing harder than others. The real trick for investors is trying to figure out how much weight to give each one. And all of this leaves us with one last fascinating question to chew on. As more and more people learn about these technical patterns, like that 150-day cycle, does that change things? I mean, if everyone knows a pattern is supposed to happen, does that make it a self-fulfilling prophecy? Or does everyone knowing about it actually break the pattern entirely? It's a paradox to keep in mind as we all watch to see what happens next.